Darshit, for giving me this opportunity to share some thoughts with you. And I'm extremely happy and pleased to be a part of this event. So I think basically we are discussing three events here. One is, of course, COVID and lockdown, but what is also relevant for India is the sharp fall in oil prices, which has some impact for us. And also what is happening to manufacturing in China, that is also very relevant for us. So I think these are three events that I would like to discuss. If you, there are two ways an economy is impacted by the environment. One is the external side and one is the internal side. And I think if you look at the, I think maybe operator could mute all other lines, so I think the disturbance would go. So I think if you look at it, India from the external side, the sharp fall in oil prices and the likely lower imports of consumer goods and gold because of the economic slowdown here, I think will lead to a situation where the balance of payments in India will be very comfortable. And in fact, it is likely that in the current year, after almost 16-17 years, we might have a current account surplus. And that is reflecting in the reasonable stability of the currency in India. So on the external side, I think India is quite fortunate, and it is great to be a part of this country in these difficult times, because the external indicators are actually extremely stable. As you must be monitoring, India's foreign exchange reserves are actually touching nearly all-time highs virtually every week. Now, coming to the internal challenges that the economy is facing, these are quite considerable, and almost 60% of India's economy is in services. 40% of employment is provided by the service sector, and India is still a low-income country, and the average income of the bottom half of the households, the bottom 50% of the households, is just about 25,000 rupees per month. So the issue is that the economy is grappling with is that when the top 10-20% of the households, who are the real spenders, when they stop going out, stop going on vacations, eating out, shopping, etc., or availing of various services, it is disrupting the incomes of a fairly large number of Indians who are in the low-income groups and employed in the service sector. Given the economic slowdown, and given the relatively high fixed cost structures of many labor-intensive sectors, especially like retailing, restaurants, hotels, airlines, automobiles, auto ancillaries, even textiles, I would say. So I think the fall in corporate profitability in the current year is likely to be considerable, because even a 10% decline or a 20% decline in the business of a retail company could lead to very sharp erosion in profitability, because the large amount of costs are fixed. So I think there is considerable pressure likely on corporate profitability in the current year. And when companies are faced with low profits or losses or tight cash flows, they will cut wages, they will cut headcount. So I think in the current year, the pressure on wages, pressure on employment, especially in the lower income groups, is likely to be considerable. I think so the impact on consumption in the economy should be considerable in the current year. And some people feel that it is only discretionary consumption that will suffer. But the point to note here is that the definition of discretionary consumption is not uniform across different income groups. For a lower income group person, when wages are challenged, even to buy an expensive bottle of shampoo and become discretionary. So I think we should expect slowdown in consumption fairly broad-based in the current year. And the private capex, which was in any case weak in India, I think will also get pushed out for the next year or so. Whatever is non-essential, companies will try to postpone capital expenditure given the challenges of the current year. So net, I feel in the current year, the economy will contract between 5 to 10%. This will be a first for India. And up till now, I have always proudly said that even in the years of Lehman crisis or 9/11, Brexit tapering, Asian crisis, Gulf crisis, in all these difficult circumstances, this economy grew every single year. But I think the lockdown is so powerful, the impact is so large that this economy will degrow for the first time in 40 years. I think, however, this economic slowdown should not last beyond the current year. And next year, I think we should see a very robust recovery, and that will be driven by various factors. And there are 3-4 issues which will support fast recovery in India, in my opinion. One is interest rates. Interest rates have moved down very sharply. And as you are aware, a large number of cars and homes are bought on EMIs, and lower EMIs means that affordability improves, and that should bring back affordability over time. So I think the importance of lower interest rates to revive economic growth in a country like India, where demand is constrained by affordability, it cannot be overstated. And that is why both the government and RBI are very focused on taking down interest rates as much as is possible. I think the external side of India is extremely strong. Low oil prices, lower gold imports, lower imports of consumer discretionary goods, and above all, lower dependence of Indian economy on exports, unlike many other emerging markets which have export-led economies. I think that places India in a very unique situation. And though India is classified as an emerging market, its characteristics are actually quite different from a typical emerging market because we are commodities exporters. Importers of both commodities like oil and of manufactured goods, whereas a typical EM is an exporter of either commodities or manufacturing goods or both. So I think the current external environment for India is actually very conducive. It is the best external environment we can ask for, because India needs capital and India imports oil, and both are extremely cheap at this point of time. So I think a very strong and a stable external sector will also help revive growth in India. The third factor, I think what will help us revive growth is, as you know, that India has a leadership position in service industry and also in the pharmaceuticals industry, the generics pharmaceuticals. But we have failed to make an impact on the manufacturing in the world, and China is the clear leader. And India has in a way missed out so far the manufacturing opportunity. I think few things are happening which make this environment interesting for manufacturing in India. One, Chinese costs have been going up over last 10-15 years steadily as Chinese economy has grown faster, as their wages have grown faster. So China is losing competitiveness in terms of costs over time, and manufacturing has been shifting away from China into other Asian countries for the last several years. So that is supportive of shifting out of manufacturing from China. The second thing, I think what is happening is, because of the disruption in supply chains, mainly based in China due to the prevalence of COVID there, the multinational companies want to reduce their over-dependence on the manufacturing supply chain in China. And there is an urgent desire to de-risk. So many companies, there is a popular phrase now, China plus one. So they would like to diversify their supply chain away from China, which is supportive for India. The third thing, I think, what has happened on the border between India and China, has brought about a deep sense of urgency in for limiting imports, for improving indigenization. I mean, as you know, Make in India has been a priority for us for many years, and I think given the current developments, there is a renewed sense of urgency to indigenize things extremely fast, and we have seen some steps in that direction. Government has said, for example, that each single year the government will come out with a negative list of defense imports or equipment that cannot be imported into India. So I think there is a very intense focus on domestic manufacturing, and a number of policy steps have been taken around that. The government is also offering a concessional tax rate of 15% for new manufacturing units. So I think given this environment, both on costs, COVID, and because of this unique border situation, the support of government for local manufacturing, I feel that India has a good chance of improving its share in global manufacturing. And this, I think, is one more factor which should help revive growth in India pretty fast. The last but not the least are the long-term drivers of growth in India: demographics, growing population, very young population, low penetration of consumer goods, high cost competitiveness, etc. I mean, you may be aware, but only 10% families in India have four-wheeler, and only 5% families have access to air conditioning. So that tells you how much potential headroom for growth is there in India, provided we are able to improve the affordability or the incomes of this large country. So net, I think next year the growth should be very high, but it will be optical because of the very low base of the current year. We may grow in high single digits, maybe, who knows, low double digits also. But I think we should ignore both the growth in the current year and next year as aberrations. And from fiscal 23 onwards, we should come back to near normal levels of growth. We have seen in the past that it is in crisis periods that most of the reforms have taken place in India. So whether it was the securities scam in early 90s, which prompted reforms in the capital markets, whether it was the balance of payments crisis in 1992, which forced the country to open up, whether it was the telecom scam or the coal mining scam, which brought reforms in those respective areas. I think the current situation, both in economic terms and in terms of what has happened with China on the border, will again lead to a flurry of reforms, and that should help bring back growth to Indian economy over the medium term. Now, coming to capital markets, I mean, many people whom I speak to, they have one question on their mind, that if the economy is in such pain, how can the markets be going up? And to be honest, I am not surprised with what is happening in the markets, though it is extremely hard to forecast markets in the short to medium term. And I've been consistently saying for last 4 or 5 months, whatever, in this through webinars, etc., that these markets offer very good value. So let me try and explain as to how can we explain this market's behavior and what is our view going forward. See, one, please appreciate the current year is a very abnormal year. It is not a normal year. If there is a shop, if there is a business which makes 100 crores profits a year in normal times, maybe the fair value of the business is 2,000 crores, 20 times profits. Now, if in a year, due to some reason, the business does not make money and its market value falls to 1,000 crores. Now, if you look at the business in terms of P multiples, it will appear to be very high, very high. Maybe it is making loss infinitely. So, but if you think 1 year forward and if you believe that the profits of 100 crores will come back after 1 or 2 years, then at 1,000 crores, it is a great investment. So the simple message in this very basic example is that please ignore the current year profits for most businesses, because you cannot value a business based on an abnormal. If a business makes a one-time gain in a year, you will not give it a multiple. Similarly, the current year are also abnormal, and therefore they should not be used to assess the value of any business. I think that is the key to figuring out these markets. To look at these markets, how they are valued, you have to focus. You can look at either last year's profits, which was a reasonably normal year, or you can look at next year's profits, or you can look at other ratios like market cap to GDP or price to book value. But I will come to that shortly. The second way to look at this whole situation is let's say a business does not make any profits in the current year. The contribution of 1 year profits to a typical business is roughly 5% of the fair value of a business. So if a business does not make money in 1 year, its 5% value goes down. So if markets fell 40%, that clearly was a knee-jerk, a very short-term excessive reaction. Assuming economy comes back to normalcy next year, the impact should not be more than 5%. That's the second point to bear in mind. The third thing to bear in mind is that the cost of capital has gone down so sharply, and therefore the value of the same profits goes up. And Warren Buffett has said that interest rates act like gravity on values of businesses. So if interest rates are down sharply, it implies the value of the businesses has moved up. So a low interest rate regime is supportive of asset prices in general. You are seeing what is happening to gold, and I think that low cost of capital, excess liquidity also has an impact on the equity valuations, and that is also playing a role here. The fourth is that even before getting into the lockdown, the markets in India were not overvalued, and they were actually moderately undervalued, and that is what we have been saying for so many years. Because I think pre-COVID, the 10-year returns of Indian markets, and this I am saying from memory, was close to 10% CAGR, which was below the rupee GDP growth of this economy for last 10 odd years. If you look at the returns today, of the 10-year returns of the index today, I think they are in mid-single digits. India's market cap to GDP is close to levels where markets have bottomed out after Lehman, after 9/11. Our price to book value is also close to the low levels that these markets have traded at in the past. And in the past, we have seen that returns from the current market cap to GDP, current price to book value multiples have been extremely strong over the next 3 to 5 years. And we have released a presentation about, I think, 2 weeks back. It is called COVID, Lockdown, Oil and More. So you could look at some of the slides there, and I am sure you will find the data that we have presented in that presentation quite interesting. So I think I am not surprised by what is happening in the markets, because I think the markets are clearly ignoring the profits of the current year, which I think everyone understands that it is an abnormal year. I think let me now just move on and share with you some thoughts around the markets going forward. As I said, these markets to my mind are moderately undervalued despite the move up, and from current levels in the past, returns have been pretty strong. And I think what will happen over time is when the headlines, the key to figuring out these markets is not to focus on the headlines of today, but to close your eyes and imagine that whenever this lockdown ends, whenever life comes back to normalcy, whenever the headlines come back to normalcy, then how will these markets look? And if you do that, then you will realize that this market offers reasonable value. I think what will also happen in time is that the risk appetite will come back. And today we are in a very unique situation, and people are so risk averse that for the first or maybe the second time in my career, I am seeing that money is going to lower yielding bond funds. And even AA companies, people are unwilling to buy, they are hesitant to buy on the fixed income side. So there is extreme risk aversion. Money is moving to the strongest banks, money is moving to the safest assets. But I think what will happen in 3 to 6 months time when the headlines change, people will not be happy with the very low interest rates that they are getting on their savings and fixed income. So I think when life comes back to normalcy, due to the extremely low level of interest rates that are prevailing, especially in India, I think we should look at very strong flows into equities from investors. And probably we are getting a taste of that in what is happening in the secondary markets. Because if you look at the share of retail participants in the trading volumes, it has gone up very sharply in the last few months. So this is one more factor that makes me optimistic about the markets going forward. If you look at the markets in terms of sectors, I think to my mind, and this is my personal opinion, there are it's a three-way market. I think, and I've been wrong in the past, but I continue to believe that the consumer companies in India, while they are very high quality companies and they have good brands, good products, I think given their growth potential, the multiples that they are trading at are very expensive. And that is one piece, one place, one segment, which I find over time, it will, in my judgment, be extremely difficult to earn even modest returns in that space, both in the consumer discretionary and the consumer non-discretionary space. This space has done extremely well, and about 10-11 years back, around Lehman, people did not want to invest in consumer, and they thought these were boring businesses, and people wanted to invest in infrastructure instead. And from those times when these companies used to trade at 15-20 multiples, today we have consumer companies going all the way up to 80-100 P multiples. So I think that was one extreme, and this is the other extreme where how the markets are looking at these consumer businesses. So this was roughly one pocket of the market which I think is excessively valued. The second part of the market is what, in my opinion, is fairly valued. And what I mean by fairly valued is that these businesses should not see a big change in the multiples, the PE multiples, etc. Instead, most of the returns should come from the business growth rate itself. So I would classify sectors like private retail banks, software, pharmaceuticals, even private oil and gas companies, telecom companies in this space. So these are good places, these are good businesses, and the returns, I think, will broadly track the growth rates in the underlying businesses in that space. The third place where I think there is considerable undervaluation is basically corporate banks, both in public and private sector. The public sector oil and gas companies, the metals companies, the EPC companies, and the utility companies. And these are the sectors which I think are trading significantly below long-term averages and significantly below their fair values. These are businesses which I think over time should deliver returns above the growth rates. Now, in my experience, markets have demonstrated 6 to 10 year cycles. Between 94 till 2000, IT led the markets. And when a sector does extremely well, a lot of money over time starts flowing into that, and people start selling all other investments. And so much so that over time, most investors are over exposed to that very popular investment. And when everyone wants to buy the same theme, the same sector, it becomes overvalued and everything else tends to become undervalued. So that is what happened to tech and to old economy around 99 2000, and eventually it corrected and tech lost a lot of money and non-tech gave fabulous returns. And that was a time when between 2000 to 2008 old economy companies went up anywhere between 10 to 30 times. Even large companies delivered that kind of returns, and that is because they were deeply undervalued to start off with. And again, the same cycle repeated itself. And as old economy started performing, what was once a hated sector, no one wanted to invest, became acceptable, became popular, became extremely popular, and finally it became so popular that just before Lehman, the real estate companies in India had market caps more than Hindustan Lever. The NBFCs had market caps more than HDFC Bank. And at that point of time, people thought pharmaceuticals, automobiles, FMCG was boring. And these were extremely cheap. So anyway, after Lehman, even that excess ended. And we have seen a few more cycles in the last few years. I mean, we saw very good returns from pharmaceuticals. It became overvalued, and from the top in 2015, it lost almost 70% value. And once pharma, please go back 4 or 5 years, it was one of the most popular investments. Something similar happened to small mid caps. And we have been of the consistent view that the returns from large caps and small mid caps are similar. The market cap of a business is the function, or the size of a business is the function of the size of the industry. And the growth is a function of the penetration of the business. So we should not confuse size with growth. So I think that excess in small mid caps has also corrected, and these have corrected very deeply in the last couple of years. So I think we are at, I've been saying this for some time, and it is always very tough to time these things exactly. But I think we are sitting at the extreme opposite end of where we were in 2007-8, when utilities were very expensive and consumption was very cheap. And today we are at the other extreme, when utilities or some other sectors that I've mentioned are offering deep value and consumption is very expensive. You can assess the undervaluation or the opportunity in India from the simple observation that many utility companies in India are offering you dividend yields which are 1 to 2 times the bond yields. Now, utilities in India are growing businesses. They are less risky businesses. They have less variables to worry about. And when growing businesses, stable businesses start offering you dividend yields, which are 1 to 2 times bond yields, I think it does point to significant undervaluation. So I think to summarize, the current times will pass, and we have seen similar events or occasions in the past. Like I have seen similar worries around 9/11, around Lehman, around tapering, around Brexit, around pigs, as if the world is coming to an end. I mean, I am of the opinion that life will come back to normalcy over time. Of course, certain consumer habits will change, like people may do more Zoom meetings and less travel, or they may maintain social distancing, or they may e-commerce usage may go up, but by and large, I think the economy and life will come back to normalcy. And I have seen time and again that the best investments have been made in times of crises, because it is at times like these that the perceived risk is extremely high, but the values are so good at times like these that over time, these investments made around such times turn out to be quite good. So I think just to conclude, I think this will pass and it will do good to India because certain decisions which are tough, which get postponed in normal times, will get taken. The external environment for India is very conducive, both on the Chinese manufacturing opportunity, low oil prices, low interest rates, and our demographics is great, and we will undertake few reforms. So I think over time this economy should come back on the growth path, and the valuations to my mind are quite reasonable, quite attractive from a medium to long term perspective. And finally, the interest rates are so low that I think over time it is inevitable that investors will come back to equities in a reasonable measure. So I think I'm quite optimistic both on the economy and around the capital markets. So let me stop here, and I'm extremely happy to answer any questions that you may have now. Thank you.
Thank you, sir. Definitely, I mean, it's always a pleasure to listen to you and get the inputs. We already have some questions between me and Darshit that we've got on the chat and on our WhatsApp as well. So the first question, because since we have a lot of NRI people with us, the first question is that why is there a divergence between US markets and Indian markets in the recovery phase? That's the first question, sir, which has come up.
See, but why? I mean, that is the nature of markets. I mean, I can give you one observation. One, the US economy always bounces back very fast. That is a very fair observation. And look at the amount of fiscal stimulus that has been done in the US. India does not have that kind of resources. So I think that is one difference. But I think we should not read too much in the short-term movements of markets. And let me give you one observation around that. All of 90s, the Indian markets did not deliver any returns for almost 10 years. And the US markets did extremely well. The next 10 years, the US markets did not do as well as the Indian markets. And the next decade of 2000, post-2000 was extremely strong for Indian markets. In last 10 years, we have seen the US markets have done very well and Indian markets have not done as well. So, I mean, this could just be a coincidence, but all I'm trying to say is that there is not much correlation between US and Indian markets over long periods of time. See, please appreciate market will grow in line with the growth of the underlying businesses. And in US, because it has a fairly large number of these tech giants, which are global businesses, which have done a lot of good to the US markets, and India does not have that type of companies. It is so I think that is also one factor that you must bear in mind. So I mean, I don't think we should be comparing US and India markets. You could look upon US and Indian markets as independent. There could be some very short-term correlations between the two markets, which typically happens around times of crises like 9/11, Lehman, Brexit, tapering. The US markets fell, the Indian markets fell for some time, but over time there was no correlation. So I would not read much into the short-term movements of the markets. I would rather focus on what are the valuations of Indian markets. And if you are optimistic about growth coming back to India, and if you agree that Indian valuations are attractive, then I think that is the right reason why you should look at Indian equities.
Right. Thank you so much, sir. One more leading question on the same line. It is also a part of what you mentioned, that we've seen positive account deficits. So it's a question that normally comes up, and it has come up again, sir, is that where do you see Rupee in the next few years? The currency, Rupee currency. Yeah.
See, stock markets are hard to forecast. Currencies and interest rates are even harder to forecast. Having said that, if you look at very long periods, the rupee has been depreciating against the dollar by 4-5% per year, because that is what has been the difference in inflation in the two countries over long periods of time. Going forward, I mean, I feel if oil prices remain low, then and if there is intense focus on indigenous manufacturing in India. See, if we start, India, by the way, has turned a net exporter of mobile phones in unit volume terms. So I don't think most of you would be aware of that. So if we manage to get our manufacturing engine kicking, not for exports, just for India, our local consumption, that itself can do a lot of good to the balance of payments in India. So I think there are reasons to not be pessimistic on the rupee. What I mean by that is we should not expect a sharp depreciation in the rupee. It is very hard to forecast Indian inflation. It is very hard to forecast medium to long-term oil prices. But I would say for the foreseeable future, given the current account surplus in the current year, given the low oil prices, low gold imports, and please remember what is happening on the FDI front. Look at what has happened to Jio, 1 lakh crores or more and counting. You know, that kind of money is willing to come to India because India offers a massive market. It offers a great opportunity, and the cost of capital across the world is extremely low. Whatever some $60-100 trillion are sitting at zero or negative interest rates. So if India opens up its infrastructure, manufacturing, and I'm sure we are trying for that, then we can get very large capital inflows into this country. And that is what I meant when I said earlier that the external environment for India is very conducive. Cost of capital and oil prices both are extremely low. So I would expect, my best guess would be, and this is just a guess, that the rupee should remain stable for foreseeable future. And we should watch out what are the trends in oil prices and what are the trends in FDI into India. One last thing here, we have seen in the last 6 months massive outflows on the FII front. And what I have observed, and there is a chart on this in our presentation, whenever there have been high outflows from FIIs in any quarter, the next year has seen very strong inflows. So if that was to be true, then I think it would also be supportive of rupee going forwards.
Okay, sir. Thank you, sir. Now coming back to our country, sir, the questions which are coming is that with the bidding of BPCL in the face of us, what are your views on PSU sector and PSU financials in general, in particular for the PSU segment?
I think there are few misconceptions about PSUs in my opinion. See, one, there is an index called the Bsc Psu Index. If you compare the returns of this PSU index with that of Sensex for 18 years between 2000 till December 2017, you will be surprised to note that the returns of these two indices were exactly the same. And there is a chart on this in our presentation. So but it is true that in the last 2 years, PSUs have underperformed markets by almost 50%. So what this tells us is that it is wrong to say that all PSUs are bad or PSUs have been underperformers forever, because for 18 years, the returns was same. I think PSUs are quite strong in some sectors, and like oil and gas, like strong banks, few NBFCs. I think these are sectors where PSUs are actually quite, and even in the power sector, they are very strong. I think we should not generalize, and there are both good and bad PSUs, and there are good and bad private sector companies as well. If you look at the challenging situations in corporate India, most of these have happened in the private sector. in the metal space, in the infra space, in the small bank space, in the NBFC space, in the power space. So if you look at the biggest NPAs, the bankruptcies, it's a long list of companies which were once considered extremely successful, have failed in many ways in these areas. So I think I would not say that we should not generalize, and both PSUs and private companies can be good or bad. I feel the strong PSUs which are dominant in those industries in which they operate, which are competitive, in this market they are offering very good value, they are deeply undervalued. And I referred to this when I discussed, and I said that the PSU oil companies, the power companies, the utility companies, the corporate banks, many of which are PSUs, are undervalued. I think this undervaluation probably was a result of the ETF strategy of divestment, which to my mind was not the right way to reduce stakes in these companies. And if the strategy shifts towards either OFS or towards strategic divestment, I think this could correct over time. So as I had said earlier, that many utility companies are offering you dividend yields which are equal to or 2 times of bond yields, and therefore to my mind these are deeply undervalued.
Thank you, sir. Sir, a very timely question has actually come up, but since it has come up, I think I should ask you, is that the current rally that we are seeing in a very, very short-term rally, is it liquidity driven or value driven?
Where is the liquidity? I mean, mutual fund flows have been, they have been weak in the last 1-2 months.
Right.
The FIs have not been big buyers. So where is the, so I think whenever markets go up and you don't expect it to go up, people tend to say it is liquidity driven, it is not fundamentals driven. But when market cap to GDP is so low, when price to book is so low, when dividend yields are 1 times or 2 times of bond yields, I would say when interest rates are so low, you are happy to buy the bond of the same company at 5%. But you are not willing to buy the share of that company at 10% dividend yield. So doesn't that tell you that the shares are undervalued? So this is a market where there are companies which are able to borrow at 5%, 4%, and their shares are trading at 8, 10, 12% dividend yields. And these companies have been given dividends for 10, 20, 30 years, and they are large, dominant companies in their sectors. So I would say, that see, rallies will always be liquidity driven, but even when there is ample liquidity, markets can still fall if sentiments change. Money does not go out of the system overnight. It just moves from one asset to another. If people are moving money from equities to bonds, the liquidity in the system is same. It is just the preference has changed. So I think what has happened is we saw intense selling. And as I said, the fair value impact of COVID or 1 year's loss of profits is just 5%. But markets fell 40% to the bottom. So they had to recover. So I would say that if you look at last 10-year returns of Nifty, they are in mid-single digits, which is much below nominal GDP growth rates. So I would not call this, I don't even worry about liquidity. All I would say is look at the valuations. Is India's market cap to GDP below long-term averages? Is price to book below long-term averages? Is the gap between dividend yields and bond yields attractive? If yes, then markets are undervalued, and it would make sense to invest for someone with a medium to long-term views.
I think very rightly explained, sir. Very simply put and very rightly explained. Another question, sir, which comes up in this time again, is that what is your view on the gold? Very expected lines, but sir, what is your view on gold, sir?
I don't think I am the right person to comment on gold. Gold is a very long-term asset class, and I look upon gold as an insurance and not as an investment. Why I say this is because if everything else fails, if you are unfortunately happening to be living in a country like Syria or Lebanon or Afghanistan, or where systems are breaking down, then gold will hold well. So gold is an insurance. When everything else fails, it will still hold value. So I think we should have some exposure to gold from a very long-term perspective. In the current environment, it is the excessive liquidity and the zero interest rates which are driving up the value of gold. If bonds are yielding you zero, if interest rates are negative, then it makes sense for capital in those geographies to move to gold, at least partly, because gold certainly tracks inflation over longer periods of time. So instead of buying a 30-year zero or 2% bond, probably it would make sense to buy gold, because I don't think you can extrapolate the current low inflation or the current low interest rate environment for very, very long periods. I don't think we are in a position to forecast inflation interest rates over 10, 15, 20-year periods. But it is quite simple to or logical to assume that there is a very strong tendency of mean reversion in interest rates, in inflation, in macroeconomic parameters. So I would say my bet would be that over really long periods, interest rates should move higher and inflation should come back. And to that extent, if you believe, I think gold does sound a reasonable investment. But it has moved up very sharply. So I would not invest in gold with a 6 months or a 1 year view. But looking at the prices of bonds, thinking 5, 10 years, and the characteristics of gold which I described, I think some allocation to gold is advisable now. And I have said the same thing for last 30 odd years. So don't read too much into this with regard to the short-term movement of gold prices.
Well, I'm sure Darshit has some questions, but before I move to Darshit, one leading question which has come out of what you just made a statement, sir, is that what is your view on Indian insurance sector? It's at a very nascent stage, but what is your view on the insurance sector? Yeah.
See, I would not like to get into details on individual sectors because there are so many sectors. But I would say, generally speaking, this sector has got listed now, but it is not a nascent sector. I mean, LIC has been there, for how many years, and many of us have been buying life insurance policies for quite some time. It is a sector that has growth in it, but it is not a sector which is deeply undervalued. I would classify it in the second bucket of fairly valued sector, which means returns should be in line with the growth rates. But I don't think we should expect very high growth rates in this sector, because this is a reasonably penetrated sector.
Thank you, sir. Darshit, if you could unmute and take it up. I think you also have some questions. Yeah.
Prashant, what
Yes.
are the risks apart from COVID to the market and the economy? You give very positive outlook on India, but what are the negatives?
See, negatives could be escalation of the border situation. Negative could be a sharp spike up in oil prices. And that is a possibility. I think it's a low possibility, but it is a possibility. Why? Because oil prices have fallen so low that investments in new oil wells may reduce. And therefore, over a few years, it is possible that oil may actually go up. It would be negative, but it would not be catastrophic for India. Because please remember, in 2008, oil had crossed $100. So after 10 years, if oil is 40 or 50, it is actually a great situation. If it was 70 or 80 also, which it was few years back, we were quite okay. But it could be incrementally negative. I think what could be also a negative is if this lockdown is extended for few more months. I think the chances of that happening are less, but if it is extended once again or COVID just refuses to come under control, I think it could have some more impact on the economy and the businesses, though I do feel that the lockdown has had mixed results in controlling COVID, and therefore I think they will continue to incrementally open the economy, and on a localized basis there could be more lockdown. So I think over time economy should come back to normal.
I think,
Yeah.
that's it.
Go ahead.
No, I was just asked. There was just one of the questions, sir, which has come up is that I'm putting it verbatim, sir, to you. Is that do you look at the ratio of price to profit margins as a measure of valuations, and based on that, what do you think will be the bottom of the market, if you feel that way, sir?
See, I think that question is not properly worded. Price to profit margins, I don't think makes sense. You can look at the ratio of price to the EPS, which is PE ratio, or you could look at price to book value, or you could look at market cap to GDP for the whole market. As I said, and these charts are there in the presentation I referred to, and Ashish will mail these to you. See, Indian markets have, whenever Indian markets have traded below 60% market cap to GDP, the next 3 and 5 year returns have been very strong. And that is somewhere close to where we are right now. See, please remember the 10-year returns of the index are in single digits. So last 10 years, bonds have outperformed equities. But we know that longer term equities outperform bonds. But for 10 years now, bonds have outperformed equities. So that is telling us that equities should do well. When dividend yields are more than bond yields in few large companies, I think that is the most easy metrics to track.
Sir, without taking a lot of time, I think we would also not want to hold you a lot. The last question. So do you think the US election would be a matter of concern to the Indian markets or India as a economy?
See, even the Indian markets are not a matter of concern for equity markets. In few years back, we had come out with a slide and we had looked at the returns of Indian markets across election years. And you'll be surprised to note that in all but one election year, irrespective of the outcome of the election, the markets delivered positive returns. So I would not say the US markets would have, US elections would have any meaningful impact on India's economy or its markets. It could have geopolitical implications. And what is the philosophy of the new government in US in terms of external relations or etc. But I don't think it has any significant economic implications for the Indian economy or for the equity markets.
Thank you so much, sir. And I think we have a few more questions, but we won't hold you longer. The questions that people would have raised to us, we will answer them. And once we receive this presentation from Ashish, we'll send it to all the participants also, so they can refer to what you just mentioned. I would, thank you, sir, and I would request Darshit to please close the day today for all of us. Yeah.
Thank you so much, Prashant. It's a very insightful presentation and your views. Thank you so much, sir. And thank you so much, everyone. Thanks for your time. Thank you so much, sir.
Thank you, Darshit. Thank you, Nishan.
Thank you. And dear all, thank you for attending this. As usual, we'll send you the recording and the PowerPoint presentation to all of you. Thank you so much. And we'll look forward to all of you to join in our future sessions. Thank you so much.
Thanks, Ashish. Thank you so much.
Thank you, Ashish. Thank you.
Thank you. Welcome, sir. Welcome.
Thank you.
Thank you for giving us this opportunity.
Thanks to all of you. Okay, thanks.
Thank you, JD.
Bye,
Thank
sir.
you,
Bye.
JD.
Take care, sir.
Thanks.
Thank you very much.
Thank you very much, sir. Thank you very much.
Thanks.
थैंक यू दर्शित भाई बहुत अच्छा था सेशन
Thank you, Mohit, Nishant here. Thank you so much, Mohit ji.
Thanks to all of you. Okay.
Thank you. Thank you, sir.
थैंक यू
Thanks.
Rupesh, thank you.
Thank you very much, sir.